Welcome to our deep dive into a company that, well, it touches nearly every corner of the globe. PepsiCo? You probably think you know them, right? Soda, snacks. But our mission today is to go way beyond the snack aisle and the soda fountain.
Yeah, peel back the layers a bit.
Exactly. We're going to look at its surprising core strengths, the challenges it's facing, and, what really makes it tick from a business quality perspective. We've got a whole stack of insights here from a really in-depth analysis.
Lots to unpack.
Definitely. Okay, so when you think PepsiCo, you probably think soda first. Yeah?
Most people do. Cola wars and all that.
Right. But here's a kind of mind-bending insight right off the bat from our analysis. Their snack division, Frito-Lay North America, that's actually the undisputed profit engine.
Oh, absolutely. Massively profitable.
It pulled in nearly 3 times the operating profit of their entire North American beverage business in 2024.
Yeah.
That just completely reshapes how you should view this company.
It really does. At its core, though, PepsiCo operates on a fundamentally simple, powerful, dual-engine model. Convenient foods, mostly snacks and beverages.
Simple idea, huge execution. Global behemoth, products in over 200 countries, generating nearly $92 billion in net revenue in 2024. Staggering numbers.
And their mission statement, to create more smiles with every sip and every bite.
Catchy. So where does all that revenue actually come from?
It's basically 3 main channels. You've got your traditional retail sales, supermarkets, convenience stores, the drill.
Okay.
Then there's food service, so restaurants like Taco Bell, schools, stadiums, places like that.
Right.
And then crucially, there's its direct store delivery system, DSD.
The DSD. That sounds important.
It is. Through DSD, PepsiCo delivers directly to over 400,000 retail outlets just in North America.
400,000 outlets.
Yeah.
Directly.
This ensures product freshness, it helps them optimize shelf space, and it really strengthens those critical relationships with the retailers.
That's truly incredible when you think about it. The logistics involved in hitting 400,000 separate spots. I mean, that's a testament to scale, but it also sounds like a massive operational beast to manage.
Oh, it absolutely is, but it highlights that deep operational strength. And this business model, it's not just understandable, it seems incredibly durable, like looking out 10, 20 years.
Why is that?
Well, it taps into these timeless human desires, right? Convenient, enjoyable, affordable food and drink.
Impulse buys, mostly.
Exactly. Small, impulse-driven purchases. That makes them remarkably resilient, even when the economy gets shaky.
And management seems aware of changing tastes, too.
Yeah, they're proactive. They're focusing on guilt-free products, lots of no-sugar beverages, healthier options, trying to adapt.
Okay, and the growth potential. You mentioned the scale, but where's the upside? The market's huge, right? $1.3 trillion globally.
Massive. And what's really interesting from the analysis is that roughly 60% of the current business comes from places that only house about 5% of the world's population.
Wow. Okay, so what does that tell us about the runway for growth internationally? Where the other 95% of people live, but where PepsiCo only gets about 40% of its revenue now.
It tells us there's an enormous, largely untapped opportunity there. And the real elegance, I think, lies in how the divisions work together. That DSD network, it's capital intensive, sure.
Expensive to build and run.
Right. But it serves both snacks and beverages, often on the same truck.
Synergy.
Totally. The extra cost of throwing a case of Gatorade onto a pallet already full of Lay's chips is tiny, but the revenue bump is significant.
So it creates this powerful scale economy at the distribution level.
Exactly. And that's incredibly difficult for a competitor selling only snacks or only drinks to replicate efficiently.
So that sounds like a major competitive advantage. How does a company this big protect itself? Our analysis mentioned a kind of fortress, right? A dual-layered economic moat.
That's a great way to put it. Yeah, precisely right. The most visible part of that moat is its intangible assets. Basically, a world-class portfolio of brands everyone knows.
Like Pepsi, Lay's, Doritos.
Gatorade, Cheetos, Quakers. Yeah. The company owns 23 distinct brands that each generate over $1 billion in estimated annual retail sales.
$1 billion each. Wow.
Yeah. And that brand strength creates what the analysis calls sticky relationships with distributors and retailers. It gives PepsiCo real pricing power.
Meaning they can raise prices when costs go up, like with inflation.
Exactly. They can pass those costs on, and largely did. Think about the Pepsi logo. Something like 94% of consumers recognize it. That's powerful.
Okay, so strong brands is layer one. What's the second layer of defense that makes it tough for competitors?
That would be its significant cost advantages. First, their immense global scale gives them superior purchasing power for raw materials. Think corn, sugar, potatoes.
Aluminum for cans.
Aluminum, definitely. And then there's that unmatched distribution network we talked about. Over 1,000 warehouses, that huge DSD network hitting 400,000 plus outlets in North America alone.
And they're not just letting it sit there, they're improving it.
Constantly. Pouring money into AI, automation, data analytics to make it even more efficient.
And we really saw this dual moat. The brands and the cost advantages worked during the recent inflation, didn't we? From 2022 to 2024.
We absolutely did. They used the brand power to push through price increases, which, consumers mostly swallowed.
And at the same time,
they used their cost advantages, executing over $1 billion in annual productivity savings, optimizing the supply chain like crazy.
So what was the bottom line effect of having both levers to pull?
It allowed them to deliver 9% core constant currency EPS growth in 2024. Pretty impressive in that environment.
So the overall moat is stable, but parts of it are actually getting stronger, widening.
Yeah, that's how the analysis frames it. Stable overall, but with distinct elements of widening. The moat around the snacks business, for instance, seems clearly widening.
Because they're the leader.
Undisputed global leader in savory snacks. And they're actively innovating, acquiring companies like C8 Foods, looking at Poppy, pushing into faster-growing areas like health and wellness.
And their U.S. market share in snacks is huge.
Commanding. Around 35%. So their scale-based cost advantages there are just getting bigger.
Okay, but the beverage side seems a bit more complicated, though the analysis still sees it as a net positive overall.
Yeah, it's definitely more nuanced there. Traditional fizzy drinks like Pepsi-Cola itself are facing headwinds. Its U.S. market share has dropped quite a bit since the 90s.
From 15% down to about 8.3% in 2023. That's significant.
It is. But management isn't just sitting there. They're smartly pivoting the portfolio, investing heavily in higher growth stuff. Zero sugar drinks, energy drinks. They have that Celsius partnership, now functional wellness beverages.
So diversifying the drinks offering.
Right. And their overall market share in the total U.S. non-alcoholic beverage market is still dominant, over 53%.
Okay. And what about the moat from distribution and the supply chain? You said that's definitely widening.
Unequivocally widening, yeah. This isn't just about having lots of trucks. It's the huge investments they're making in automation, AI for inventory, automated guided vehicles and warehouses.
Real tech investment.
Big time. It's transforming their logistics. Things like cutting order processing times by 50%, operating costs down 15%. That makes it incredibly difficult and expensive for any competitor to even try to match their logistical muscle.
So the market might focus on the cola wars, but the real story, according to this analysis, is snack supremacy, evolving the beverage portfolio, all built on a distribution network that's getting stronger every year.
That's the core argument. Yeah, the synergy is key.
Okay, so we've established these huge structural advantages, the financial muscle, but even the strongest fortress, can have issues inside, especially when you think about the people, the customers buying the stuff, the employees making it all happen. How does that human element factor in?
That's a really important angle. On the customer side, generally, product reviews for the big brands are pretty favorable.
People like the taste.
They do. And things like loyalty programs, they mentioned one in Turkey called Kazandirio, have been successful, engaging millions, boosting sales from loyal users. Quantitatively, their overall net promoter score, NPS, is a solid plus 22.
Okay, plus 22. Solid, but, well, it lags quite a bit behind Coca-Cola, which is at plus 39, and especially best-in-class brands like Chick-fil-A at plus 55.
Right. Big gap.
So that's not just a number, is it? Doesn't that point to a potential vulnerability? Even with iconic brands, if the actual experience isn't top-notch, does that affect loyalty long-term?
It absolutely could. And when you dig into customer complaints, you see these consistent patterns around execution.
Not the product itself, but the delivery.
Exactly. Vending machines breaking down, quality control issues like flat drinks or finding expired products on the shelf, frustrating customer service when trying to get, say, a direct refund. It's about the blocking and tackle.
Okay, so that's the customer view. What about inside the company? The employee perspective. The analysis mentioned a split there, too.
Yeah, quite bifurcated. At the corporate level, employees generally praise things like excellent benefits, an inclusive culture, smart colleagues, great training. They often mention a family atmosphere.
Good perks, too.
Especially the 401k match, that gets highlighted a lot. Sounds pretty good at HQ.
But there's always a but.
Yeah. The feedback from the frontline workers, the folks in operations, sales, warehouses, paints a much tougher picture.
What are the main issues there?
A recurring theme is poor work-life balance. People reporting being worked to death, expectations of 12, even 16-hour days.
Oof, that's intense.
Yeah. And there's this palpable sense of disconnect from corporate leadership. Calls for management to, and this is a quote, actually come to the facilities and see the frontline opportunities.
So a real disconnect between the strategic center and the operational edge.
Exactly. And this divergence is really crucial to watch. The bland strength is undeniable, right? But the frontline execution shows clear signs of strain.
And those customer complaints tie back to that.
Precisely. They're about execution failures, not taste. And the employee complaints are about the operational realities. Remember, that DSD model, the manufacturing scale, key parts of their cost advantage moat, they're powered by hundreds of thousands of frontline employees.
So if that workforce is overstressed or feels unsupported,
then the quality of execution can slip, leading to exactly the kinds of problems customers complain about and potentially a slow erosion of that valuable brand equity over time.
Okay, so that's a critical link. Let's talk about leadership then. Who's steering this massive ship through all this?
The CEO is Ramon Laguarta. He took over in 2018. He's articulated this clear long-term growth philosophy called PEP Plus, or PepsiCo Positive.
That plus square. What's the idea behind that?
He's positioned it as their core transformation agenda for creating value. It focuses on being faster, stronger, and better. It seems like a logical evolution from his predecessor, Indra Nooyi's Performance with Purpose initiative, which was quite successful.
And how does that translate into how they use their money, capital allocation?
Well, the track record there looks remarkably consistent, rational, and pretty shareholder-friendly. They follow a clear, prioritized framework.
Okay, what's top priority?
Highest priority. Reinvestment back into the core business. Since 2018, their annual spending on CapEx, advertising and marketing, R&D that's gone up from around $8 billion to $12 billion.
Wow, big increase. Where's that going?
Strategically aimed at modernizing that supply chain we talked about and driving top-line growth. Basically, strengthening the economic moat.
Makes sense. What's next on the list?
Second priority, a reliable and growing dividend. PepsiCo's a dividend aristocrat, which is pretty elite status.
Meaning they've raised it consistently for a long time.
For 53 consecutive years, they're planning $7.6 billion in dividends for 2025.
Okay, reinvestment, dividends, then acquisitions.
Yeah, selective acquisitions, used mainly to fill portfolio gaps in high-growth areas, like buying C8 Foods or the pending deal for Poppi, both tapping into that health trend.
Addressing that consumer shift we mentioned.
Exactly. And then finally, the residual use of cash is share repurchases. But they're only planning a modest $1 billion for 2025.
Which suggests they prefer investing in the business and direct cash returns over, say, financial engineering.
That seems to be the signal, yes. A priority on fundamental business investment.
You know, that balanced approach, reinvest, reward shareholders, selective growth, that sounds like exactly what a long-term investor would want to see, right?
Yeah.
Reinforcing the core advantages.
It really does. It's almost a textbook example of a wonderful company, as Buffett might say, strengthening its competitive position through heavy rational investment, especially in automation and digitalization, making that distribution network even harder to challenge.
And the numbers back this up. How's the actual performance been?
Quantitatively, PepsiCo is just a highly reliable, consistent earnings machine. Over the 5 years leading into 2024, they grew net revenue by 37%.
Pretty solid.
And core earnings per share, up an impressive 48%. Net income shows a clear upward trend, too, from about $7.1 billion in 2020 to nearly $9.6 billion in 2024.
So strong growth. What about profitability and efficiency? How does that look?
Key ratios look good. Their return on invested capital, ROIC, consistently comes in around 12-14% recently.
And how does that compare to their cost of capital?
It's significantly higher. Their weighted average cost of capital, WACC, is estimated around 5.5%. So that wide positive spread, that's the definitive quantitative sign of a superior business creating substantial economic value.
Generating more return than it costs them to fund the business.
Precisely. And their free cash flow, or FCF, conversion is strong too. They consistently turn a large chunk of their reported net income, often 80-90%, into actual spendable cash for the owners.
So their earnings are real, they're turning into cash. And the balance sheet, how much debt are they carrying?
Their balance sheet strength, measured by net debt to EBITDA, is about 2.2 times for fiscal year 2024.
Which is Good,
As
bad.
a stable, cash-generative business like PepsiCo that's very prudent and manageable, it indicates they have plenty of financial flexibility,
Yeah.
not over-leveraged.
Okay, so we've dug deep into the business quality, the moat, the management, the financials. It sounds pretty robust. Now, the $1 million question, or maybe the $92 billion question. How does the current market price stack up against all this?
Well, right now, PepsiCo is trading at a notable discount compared to its own recent history.
Cheaper than it has been.
Yeah. Its price-to-earnings ratio, the PE, is around 19.3. That's significantly below its 5-year average, which was closer to 26.6.
Okay, that's quite a difference. Any other valuation metrics showing that?
Similarly, its price-to-free cash flow ratio, PFCF, is about 24.7. Again, more modest than the past 5 years, where it often traded closer to 30 times free cash flow, sometimes higher.
So, based on our deep dive into the quality of the business, the rational management, does this current price look like an opportunity?
The analysis suggests that, yes, the current market price represents a fair to potentially attractive entry point for an investor with a long-term view.
Because the market's focused on short-term issues.
It seems that way. The discount appears driven by near-term and likely temporary headwinds, things like slowing volume growth in some areas, some margin pressures, maybe consumer pushback on those price hikes. A long-term investor can arguably look through that noise.
And looking long-term, what's the biggest engine for future earnings growth? Where does the analysis point?
The single most important driver over the next decade looks like international expansion.
Going back to that 95% of the population untapped.
Exactly. The international business is already 40% of revenue and profit, and it's been growing at a robust 10% compound annual rate over the last 5 years. The opportunity there is still just vast.
And they're investing to capture that.
Significantly, investing in manufacturing capacity, talent development in key growth markets.
Okay, that sounds like a huge runway for growth. But for a company that's already so big globally, what are the real hurdles to unlocking that massive international potential? Is it just about getting products onto shelves, or is it more complex?
Oh, it's definitely more complex. Market penetration is part of it, sure, but then you're navigating incredibly diverse regulatory environments. You need to adapt to hyper-local tastes. What sells in India might not sell in Brazil. You have to build out reliable cold chain logistics in many emerging markets. Figure out how to source raw materials sustainably in new regions. There are definitely layers of complexity involved. It's not just plug and play.
Okay, so opportunity, but challenges too. And we also need to acknowledge the genuine long-term risks, right? Things that could really damage the business permanently. What are the big ones?
The analysis highlights 3 major ones. First, that accelerating health and wellness trend. If society really rapidly shifts away from processed, salty, sugary stuff.
Faster than they can innovate or buy new brands.
Exactly. That could really hurt the value of their legacy brands and the new GLP-1 weight loss drugs like Wegovy and Ozempic. That's a huge new uncertainty thrown into the mix. Nobody really knows the long-term impact yet.
Okay, health trend is one. What's number 2?
Punitive regulatory attack on sugar and plastics. Governments everywhere are increasingly looking at sugar and single-use plastic as, negative externalities.
Things society pays for indirectly.
Right. So if you get a coordinated global wave of punitive sugar taxes, major advertising bans, really strict plastic packaging rules, that could significantly hike costs, depress sales, and permanently lower their margins.
The regulatory pincer movement. And the third big risk.
Climate change and water scarcity. PepsiCo is fundamentally an agriculture-rooted business. Climate change poses significant physical risks to their key inputs: corn, potatoes, sugarcane, water.
Water seems critical for beverages and growing crops.
Absolutely. Water scarcity is a huge issue. One financial think tank actually estimated that PepsiCo could face potential financial risks of as much as $4.4 billion per year by 2030, just from climate-related risks.
Wow. Okay, those are some serious long-term threats to keep in mind. So, bringing it all together, how does our deep dive analysis stack up against what the general market seems to think about PepsiCo right now?
Well, the current market consensus seems to be one of caution, skepticism maybe. The general view is high-quality company, sure, but slow-growing defensive stock facing these near-term headwinds we mentioned, weak North American volumes, margin pressure.
Which leads to
a pretty lukewarm hold rating from most analysts, generally speaking.
Okay, that's the market view. But our analysis seems to suggest a different take, maybe a contrarian view.
Yeah, it really does. It highlights what you might call a classic case of first-level versus second-level thinking.
How so?
The market appears to be underestimating the durability and especially the widening nature of that integrated snack and distribution mode. It often seems to view PepsiCo as two separate things.
Like a challenged North American drinks business and a solid but maybe mature snack business.
Exactly. But this analysis reveals it more as a single symbiotic ecosystem, the combination of snacks and beverages delivered through that unified, increasingly automated DSD network. That creates this formidable cost advantage that's actually self-reinforcing and getting stronger with technology investment.
So while the market is maybe fixated on, say, a 2% volume decline last quarter,
right. A second-level thinker, looking at this analysis, would place more weight on the 48% increase in core EPS over the last 5 years, or that consistently high ROIC that's more than double their cost of capital.
connecting the dots differently.
Yeah. The market's maybe worried about next quarter's gross margin. A long-term owner, focused on this analysis, is thinking about the next decade's free cash flow, which is being secured and enhanced by today's heavy, rational reinvestment in the business.
So the market might be extrapolating near-term weakness.
While this analysis sees a really wonderful company strengthening its fortress during a period of temporary headwinds, offered at what looks like a fair price.
Okay, so our synthesis basically presents a clear bull case. Wonderful business, widening moat, rational management, strong financials, fair price, versus a bear case. Permanent health shift, regulatory threats, tricky international execution, maybe it's a value trap.
That sums it up pretty well.
Is there one single argument that really challenges the bull case? Like the strongest red team counter-argument?
I think the most compelling one is if that consumer shift towards health and wellness isn't gradual, but a rapid phase transition, a fundamental break.
What would that look like?
In that scenario, the rise of GLP-1 drugs, maybe some other factor, creates this hyper-awareness of health that fundamentally and permanently changes habits. Core Frito-Lay and Pepsi brands suddenly become stigmatized, maybe like tobacco is now.
Retailers would cut shelf space.
Brands become liabilities, not assets. Governments slap on punitive taxes that crush margins. And the cash flow from those legacy businesses, which funds everything else, the dividends, the acquisitions, the R&D, it dries up much faster than anyone anticipates.
Making those acquisitions too little, too late.
Exactly. In that scenario, the economic moat, that fortress we talked about, is revealed to be kind of brittle. Maybe a single point of failure around consumer tastes. The company turns from a fortress into a melting ice cube.
A classic value trap. Looks cheap, but the underlying value is eroding fast.
That's the nightmare scenario for the bull case, yes.
Wow. What a deep dive into PepsiCo. From that symbiotic snack and beverage empire, the power of DSD, to the hidden complexities of customer and employee experiences. It's clear there's just so much more to this familiar company than meets the eye.
Absolutely. And given PepsiCo's long track record of adapting and these significant investments they're making now in future-proofing the business, it leads to a really interesting question.
Which is?
How much of that permanent impairment risk we discussed is truly a permanent threat, and how much is just the next big test of a resilience that this company has actually proven over many decades?
That is a powerful question for you, our listeners, to ponder. We hope this deep dive has given you a fresh perspective and some genuinely valuable insights to consider next time you grab a Pepsi or a bag of Doritos.